Have you ever wondered why your bank will sometimes offer you a decent interest rate, only to cut it a few months later, and then offer to raise it again a few months after that? In this video, I'm going to show you exactly why that happens, and importantly, how to protect yourself even if you decide to stay at the same bank.
Holy Schmidt!
I don't know about you, but I have a love-hate relationship with my bank. I love the staff there, but I hate how the bank games interest rates. This is particularly true when the Federal Reserve rate is 4% or nearly 4% as it is today, and my bank is offering 0.01%. Now, I have a ritual. On the first day of every new quarter, I walk into my bank and ask what the rate is. Sometimes it's 3%, sometimes it's 3.5%, sometimes it's 0.01% as it is today. I might add that I've achieved these rates all in the same account, and nothing really significant has changed in the interest rate market over the last 12 months. Certainly there hasn't been a Fed cut of 3 or 3.5%. Now, the truth is, I know why this happens, but a lot of people don't. And so this video is going to show you exactly why, so you can make better decisions about where you put your money and hopefully make more money with your money. Now, one final point before we move on, particularly for boomers and Gen Xers. It didn't used to be this way. You're not hallucinating. Before interest rates went down to basically zero, you would see mortgages at 6 or 7% and deposits at 4 or 5%. And there was no big fluctuation like you see today. That all changed when interest rates went down to zero. And even though they're back up again, the banks have not raised rates consistently anyway, like they did in the past. And here's why. The first reason is that a bank is a business. It's not a vault, it's not a government entity, and its objective is to make money. When you put $5,000 or $10,000 in a bank, it treats that as a loan, and then it will re-lend your money out to someone else. And the difference between what they pay you and what they get from the new loan is what's called profit margin. So if a bank takes your deposit and pays you 0.4% and then lends it out for a mortgage at 7%, its profit margin is 6.6%. You take that profit formula and you apply it across thousands, tens of thousands, millions of depositors, and you have a lot of money. So a low rate to you isn't a glitch. The less they pay you, the more money they make. None of this makes a bank evil, by the way. It provides real value. Your deposits are insured up to $250,000, and your transactions are processed. The rate that you're given isn't the rate that it could pay. It's the rate that keeps its margin the widest while keeping you as a customer. So a bank is like any other business. If you walk into a car dealership, the sticker price isn't the price that most people pay. It's the opening offer. A savings rate at a bank works the same way. The rate that they post is often the rate that is advertised, but it's not the best rate. It's not the one that you can actually get. If you ask, you could get a higher rate. And to be really clear here, there's a pattern worth noticing. The banks with the biggest brands tend to pay the lowest rates. They don't need to pay more because people will keep their money there anyway. Smaller online banks pay substantially more, a lot more, something like 30 or 40x more in many cases because they don't have the brand name, but they have the same protections. They have the same FDIC insurance. You get the same dollar back when you take it out, but you get a higher rate. And the design favors the bank until you decide to shop. Now, there are times that a bank will pay more, but almost always it wants something back. We just saw that your low rate is a bank's profit margin. So why would a bank ever raise your interest rates? The answer is that it generally won't unless it gets something else of value in return. A bank doesn't give out its margin because of kindness. Every interest rate increase has something attached to it. And once you know what the bank is buying, you can make a decision on whether the deal is good for you too. The first thing a bank wants is your loyalty, and it will pay a little bit to lock that in. A better rate comes with a promise, either explicit or implicit, that you won't move your money. You're going to keep your money at that bank. Keep the balance here, keep your direct deposit here, keep the relationship, and we'll pay you a little more. The bank has already run the numbers, and paying you a little bit more to stay is cheaper than going out and finding a replacement deposit. For you, that can be a fair trade as long as the rate stays competitive and it's not an introductory rate that goes away after they've got you. The second thing a bank wants is new money from another bank. They want you to bring money from another competitor and bring it to them. That's why you often see offers that say, bring in $5,000 and we'll pay you 3%. The bank isn't being generous, it's just buying deposits off of a competitor, and for every dollar that they get, it's a dollar that the rival loses. The third thing a bank wants is a new account, and here it's playing the long game. It knows that if a certain number of people open a new account, a certain percentage of those accounts will still be there in 3, 4, 5, 10, 20 years. And they'll continue to feed the bank over time. They'll put in more money. They'll set up direct deposits. They'll take out a mortgage from the bank. The list goes on and on. This doesn't mean you're a lucky winner of a good rate. The bank expects to win a lot more business from you over time and probably reduce the rate along the way. It's no different than if you bought a subscription online and you paid $1 a month for the first year and then the rate goes up after that. Or if you took out a new credit card and you get 75,000 miles free, 100,000 miles free, the number can be a very large number because they're going to get it back in the months and years ahead. So how do you use this? Well, you treat these offers as a negotiation. You know what they want. It's not benevolent. They want you to deposit money into the bank, or at the very least, not take your money and give it to a competitor. Now, before you agree to anything, you need to examine the fine print. I'll show you how to do that a little bit later, but if the terms are good, take the deal and let the bank buy your business. And if the terms aren't good, well, keep your money where your money is being treated well. No need to move. Now let's talk about the elephant in the room, and that is they're betting that because of human nature, even if they cut your rate down to 0 or close to it, you're not going to move your money. And the fact is, banks study this closely, and most of the time they're right. They have the data. Most people open a checking and savings account once, set up direct deposit, put a few bills on autopay, and then never touch the setup again. In banking, deposits that stay put like this are called sticky, and sticky money is cheap money for the bank. If a bank knows that 9 out of 10 customers, for example, will leave their money in the bank no matter what, they have no reason to pay those customers outside of some minimal amount. And if they think about what keeps you in place, they might be right. Think about how tied you are to your bank. Your paycheck lands there. Your mortgage gets paid out automatically. Your utilities get paid out. Your subscriptions all pull from that same account. Moving it feels like a chore, and the fear of missing payments keeps people frozen, and the bank knows this. And the group that gets hit the hardest, by the way, usually retirees, because they have the biggest balances and they've been loyal for 20 or 30 years in many cases. Now, the good news is that friction is much smaller than it feels, because you don't have to move your checking account. Your savings account is where all the big dollars are. You can open a separate high-yield savings account at another insured bank and link it to your existing checking with a couple of account numbers. Your paycheck and your bills stay exactly where they are. You simply move your money to a bank that pays you properly, and transfers between the new bank and the old bank usually takes a day or two. And the bank is betting that the inconvenience to you is worth more than the return on the money that you would have received. And on small balances, they're probably correct. But on balances of, say, $25,000, $50,000, $100,000, they're probably not correct. So the bank's making a bet, and when the bank feels like it's losing the bet, they'll raise rates. And that's what you see happening sometimes inside the bank, where all of a sudden your rate goes down, and then a few months later, you're offered a higher rate if you simply do something. Change the code on your account, for example. Gang, if you're using spreadsheets to manage your finances, you're doing it the old-fashioned way. The fact is, if you make a mistake in one cell, it could have a ripple effect in the entire sheet, maybe even your entire financial plan. Now, on this channel, we have 3 affiliate relationships. One is Bolden Personal Financial Planning Software. That's the personal financial planning software that I personally use. With Bolden, you can run forecasts, run your plan through optimistic, average, or pessimistic assumptions. You can set up to 10 different what-if scenarios and compare as many as 3 side by side to see how your choices play out. You can set up a must-spend, like-to-spend budget and set up withdrawal strategies for retirement. If this is of interest to you, you can get 2 weeks free of their full featured software by using our affiliate URL. Just go to go.bolden.com/Schmidt and try it for 2 weeks. After 2 weeks, if you decide to keep it, it's just $12 a month paid annually. Now, one thing you need to know about banks. Generally, unless they're forced to do so, banks are slow to raise rates and very quick to cut rates. Let me explain. What I just described is what's called deposit beta, and it's just a measure of how much of a Federal Reserve rate change actually gets passed on to you, the saver. When the Federal Reserve raises rates, they make more money off of your deposits almost immediately. But they don't have to share those raises with depositors, and many do not. So the rate on your savings creeps up slowly if it goes up at all. But when the Fed cuts rates, that is passed through almost immediately. This is because if they didn't, their lending income would be shrinking, and they want to protect the margin. Up slow, down fast. That asymmetry is a choice, and it favors the bank in both directions. So let's put some numbers on this. Today, the Federal Reserve's target rate is between 3.5 and 3.75%. That is the safe rate that a bank can get if they put their funds on deposit with the Fed. Meanwhile, the national average savings account pays 0.4%, and many pay as low as 0.01%. So the Fed is near 4%, and the bank is earning near that on your money, and you're being handed a rounding error, in many cases anyway. When you put that in dollars on a $100,000 balance, a rate of 0.1% pays you about $10 a year. At 4%, that same $100,000 pays about $4,000 a year. Same money, same FDIC insurance, a swing of about $4,000. Now you compare that rate to a high-yield savings account. High-yield savings accounts are paying close to 4%. Those online banks are paying close to what the Fed rate is because they have to compete. They don't have the brand. And this is why waiting for your bank to catch up is usually a losing game because of deposit beta. Up slow, down fast. The same bank that pays you almost nothing very often owns a separate higher paying savings account with basically the same terms, and you're simply not in it. Many banks offer two brands under one roof. There's the traditional brand with the name that you knew and grew up with and you've been with for 10, 20, 30 years. And then there's another brand, often completely separate, with a name that you might not even recognize. The traditional brand, whose name you might know well, might pay 0.01%, and their online brand close to 4%. Now, the bank isn't exactly hiding it, but they're not going to call you and suggest that you switch either. You need to find this out for yourself. Now, why do they do this? Because it allows the bank to have it both ways. They keep their traditional deposit base, and they also attract the high-yield depositors that are price sensitive. One of the most powerful options you have is also one of the simplest. Ask your bank directly, do you have a high-yield online savings account option? Sometimes the answer is yes, and you can keep your money in the institution that you love and get the higher rate. You might even be able to use the same login. And if they say no, that's useful information as well. It tells you that the bank has decided not to compete for depositors that are rate sensitive. And by the way, there's no loyalty penalty for putting your savings at an institution that treats it well. The safety point, by the way, matters here, and it stops a lot of people. A high-yield savings account at an FDIC-insured bank carries the same $250,000 insurance as your old bank with a brand name. The higher rate doesn't come from the bank taking on more risk. It comes from a bank that has decided that it's going to compete in the deposit market by paying out more of its earnings to you. So one reason your rate is low may simply be because you're in the wrong account at the right bank, and the better rate might be one phone call away. Now let's talk about the rate on the sign that you see when you walk in the bank, because often that's not the rate you actually receive. Banks have a number of ways to make an offer look better than it actually is, all perfectly legal, all contained in the fine print. Once you know the common ones, then they become easy to spot. The first is what's called a teaser rate, often called an introductory rate. A bank advertises an attractive number to get you to open the account and move your money in. Then, after a few months, the rate resets to something far lower, and most people never even notice because they're not checking. The headline did its job. It got you to move your money into the bank. The second is called balance tiers. An account might advertise a higher rate, but it's only available at a higher tier. The first tier has a lower rate. When you read the information carefully, you might find that the rate that you think you're getting only applies to a very small portion of your overall deposit. The third is what's called a bundle requirement. To get the advertised rate, you may need to also keep a checking account, set up a direct deposit, hold a minimum balance, or make a certain number of transactions each month. Miss one condition and the rate steps down. The rate is real, but only if you clear every single hurdle. Now the cleanest rate, and often the best one, are the ones without these requirements. No teaser rate, no bundling requirements, no tiers, nothing like that. A flat, straightforward rate with no expiration date is often better than a higher introductory rate. And the final point here is actually the solution. Once you understand why your bank pays so little, the fix is to move the money to a place that pays fairly without taking on risk that you don't want. There are 4 main options, and all of them might be appropriate for retirement savings, for example. The first is a high-yield savings account. This is what we've been talking about all along. It's usually a bank that's not nearly as well known, and they're competing for your deposits. It's a plain savings account, usually at an online bank, that pays a competitive rate, around 4% in the summer of 2026 anyway. It's FDIC insured up to $250,000, and your money is available whenever you need it. For most people, this is the simplest upgrade and the right home for an emergency fund. The second is a true money market fund. I'm not talking about a bank money market fund, but a money market fund at a brokerage. Now, these funds aren't FDIC insured, but the government type holds some of the safest paper that exists. They've been paying rates in the same neighborhood as high-yield savings accounts. It's important to ask whether you're being offered a fund or a bank account because the protections are different. The third is Treasury bills. These are short-term loans to the U.S. government, backed by its full faith and credit, which is the highest grade of any safety available. You can buy them directly through Treasury Direct or inside your brokerage account. And a helpful bonus for you, interest on most Treasury bills is exempt from state income tax. The fourth is a CD. Now, with a CD, you make a deposit at a bank and you guarantee not to touch it for a period of time, 6 months, 12 months, etc. And in return for that, you get a guaranteed rate for that period of time. They carry the same $250,000 FDIC insurance protection, and they're useful if you think the Fed is going to be cutting interest rates in the future because your rate is locked in. Notice what all 4 have in common. Each one is either government insured or government backed. Each one is available to an ordinary saver, and each one pays many times what a big bank savings account pays today. You're not reaching for risk that earns more, you're simply refusing to accept less. So the last reason to understand all of this is that the alternatives are generally safe, simple, and easily within reach. If you like this video, check out that video. Don't roll your 401k into an IRA until you know this lawsuit trap. Also, don't forget to check out Bolden. Simply go to go.bolden.com/Schmidt for your 2 free weeks. This is Jeff Schmidt, and I will see you in that video right there.